going on, everybody? Welcome back. Just wanted to give you an update on how things are going with my market making algorithm, and also let you know a little bit about some other stuff I'm kind of been working on, some stuff that I noticed as far as potential opportunities that we could be taking advantage of as traders in the crypto market. So anyway, just a quick update on where things are at with my market making algo. I put a new version out there that I've been just testing on Bitcoin recently. And basically, what I wanted to do with the order book imbalance information that I have, I was previously skewing the quotes and widening the spreads if the order book imbalance got um, a bit too far on one side or the other. But what I decided to do is for this next iteration is just to completely get out of the way. So if the order book is going full on buy mode, I don't want to have an ask sitting out there for 30 to 60 seconds. I'm just going to pull any entry order if I'm short, for example. I just want to pull any entry orders because I don't want to get even shorter if the market is about to move up another 10 basis points in the next minute or so. What I'm really trying to do is avoid adverse selection here, and I'm going to see if this has any improvement at all to the strategy. So I've got this running out on Bitcoin now. I might pick one other, maybe slightly more volatile coin, just to see if there's um, anything here with testing out this theory. For Bitcoin, definitely there is definitely a very, very strong correlation between order book imbalance and short-term price moves over 30 to 60 seconds. Now, these price moves aren't big enough to trade on their own, but they could be a bit of an improvement to the market making strategy if you can reduce the amount of times you're getting picked off by informed traders. So I started running this version about a week or so ago, and don't have any I don't have any results to post just yet on it. And actually, I had, let's see here if I can pull it up. I just got 2.7 is the version, and 2.6.1 is the previous version that was running. So I hope to have some results that I'm going to kind of tabulate this week, both on a daily basis. How are these strategies comparing side by side, day to day, and then also just trade by trade, like how are the trades looking? Is there any improvement at all between these two versions of the strategy? So the other thing that I noticed as I got into this more, especially with some of these smaller coins, is just this huge discrepancy between the funding rates on especially some of these smaller coins, but even lately with the way that crypto market has just been tearing it up. Ripple is up at like $3.30 now. It hit a price even higher than that. And so the funding rates on these coins are just, in my opinion, just ridiculous. People were paying on DYDX, for example, 100% funding rate to go long. And on other exchanges such as Paradex, the funding rate wasn't as high. It was probably about 30-40%. So there's definitely an opportunity there to do some funding rate arbitrage, and I'm starting to look at that as well. So I want to take a look at the funding rates on these coins and these futures, really, the perpetual futures contracts, for a couple of reasons. First of all, if we're trading like a coin that has just a crazy, even if it doesn't actually have a crazy funding rate, if the funding rate is 50%, that's like pretty high. But some of these coins I've seen lately, the annualized funding rates are like 500, 600%, which is just kind of mind blowing that somebody is going to pay that much to gain leverage for these coins. Now, what I'm thinking of is, okay, there's a couple ways to to potentially play this here. One way is to modify the market making algo to only go either long or short on the side of the extreme funding rate. So like, let's just say for the sake of example, the funding rate for Ripple was, sitting at 100% plus 100%, which means that the longs are paying 100% annualized to hold those futures contracts. They're paying that 100% to the holders that are short, just basically to gain long exposure to the contract. Now, if I modify my market making algo to say, hey, I'm only going to play the short side, so I'm not going to be going long. I'm just going to be looking to open short positions and close short positions out, but I'm not going to be going long. So basically, both trying to make the spread with market making and the rebates on Paradex, and then also get a bit of short exposure on these coins to earn the funding that's getting paid on these positions. So actually, I modified my paper broker, or my kind of mock broker, to account for the funding that gets paid while these positions are open. So that's one thing that I'm going to be modifying my market making strategy to do. But then I'm also going to be just looking at just doing flat out arbitrage between these different exchanges, and basically taking advantage of the discrepancy between the funding rates, because some of these discrepancies are just, yeah, again, mind-boggling. I don't understand why somebody's going to pay so much more to get leverage on DYDX versus not on Paradex, right, or not on Hyperliquid, for example. So if we just take a look at, we got XRP here on Paradex, and we can see the 8-hour funding rate here. So annualized, that's about 14%. So the longs are going to pay the shorts about 14% annualized rate on this. Now, if we go over to DYDX, the longs are paying the shorts an annualized rate of 55%. So roughly a 40% difference in funding rates. Now, you could go long on Paradex, pay the 14%, and go short on DYDX, collect the 55%. So you're netting the 40% difference and be delta neutral. Now, also, like, just looking at the prices of the contracts themselves, they seem to be fairly in line. Although some of these times you'll see a premium, slight premium or discount on one exchange versus the other. So that's another thing to kind of keep in mind. And then, of course, there's commissions. So you're going to be paying, if you're doing maker orders, you're basically getting in with limit orders. You're definitely going to keep your costs down, versus if you're doing taker orders or market orders, you're going to be paying a higher commission on those. Now, the cool thing about DYDX is you can actually plot out the past funding rates. They'll show it to you here, and this is for Ripple. You can see, or maybe you can't because the text is kind of small here, but it peaked earlier today at 163% annualized. Now, you'll see that it fluctuates constantly throughout the day, and it does go from positive to negative, which means you kind of got to keep an eye on things. But in general, on DYDX, the funding rate has been positive, and it's been usually higher than what's getting paid on Paradex, for example. So what you could do here is, given that you're delta neutral, you could leverage a bit, and then as these positions move around, as far as the prices go, and one goes into profit and one goes into loss, since you're going to be long on one exchange and short on the other exchange, you move funds back and forth as needed, just to make sure you're not getting liquidated. So this is another thing that I'm going to be testing out. Not really anything to automate here just yet. I think the the trades themselves for these are going to be a bit longer time frames. We're talking about hours or days potentially where we'll just leave these positions open. What I might want to automate though is the transferring of the funds between the exchanges, because let's say Ripple starts taking off in the middle of the night, and I'm not just sitting at my desk here keeping an eye on things. I don't want to get liquidated. So ideally, funds could get moved over from one exchange to another, so that doesn't happen. But that's another thing to kind of keep an eye on. I expect that with a lot of attention turning towards crypto and a lot of things about stable coins in the news, we're going to see more and more people, especially both retail and institutional investors, get into this space, which means I think especially for the smaller coins, less liquid coins, we're probably going to see funding rates uh, be relatively high, because these traders are going to want to gain leveraged exposure to some of these contracts. So if you can be nimble, these strategies aren't going to have a huge capacity, so you're not going to be able to necessarily trade millions of dollars uh, on these strategies, just because it's going to be hard to move money in and out quickly. But if you've got a small to moderate amount of capital, you might be able to make a pretty decent return playing the funding rate arbitrage game here. So I'm going to be starting to track this in addition to my market making results. I'll post them here once I've got something worthwhile to show, and we'll see what things kind of look like to see if this is going to actually be a viable strategy. So anyway, as always, love to hear what you guys are working on out there. If you got any questions, comments, feel free to drop them below. And I hope you guys have an awesome week. See you later. Bye.